We had a real housing recovery, and the emphasis is on had, starting in early 2026. Now it's fragile, and it just got slowed down yet again. Big update from the National Association of Realtors, and this one really matters. And this has been the theme this week. I've been talking about a slowing housing recovery, one that had started out pretty strong here in 2026, but it doesn't look good. Chief Economist Lawrence Yun has officially revised his 2026 forecast for existing home sales growth down to 4% from, get this, 14% just a few months ago. That is a major revision. And Lawrence Yun, he's the chief economist there at National Association of Realtors, the NAR. That is a pretty big deal. His responsibility is pretty significant. What he presents, what he provides, most people definitely tune in and listen to. And I want to reemphasize, this is a huge shift in what he thought before. I'm going to get into some of his comments. He said just the other day, he just came out the other day, earlier this week, and Yun said, paraphrasing here, mortgage rates have been rising, and that has led us to trim our home sales outlook for the year. So he points again to rising rates and how major that impact really is. He also added, I don't think we will get that 6% mortgage rate average. All right, so what have I been saying, in the last few episodes is exactly that. I think we're going to just stay in this sort of range that we're in. We're hovering around 6.36% around now. And, what we had earlier in the year, right, around 5.99%. Some folks were getting that low an interest rate on mortgage 30-year fixed rates. Lawrence Yun says we're not going to be seeing that anytime soon. And, because, he originally was pretty bullish. I mean, his forecast was, 14% as far as sales growth, existing home sales growth. So how many sales actually can take place, how much movement there is in the housing market, how much buying, how much selling. That is a major drop, and it's pretty sad. But again, his forecast, that was based on rates going lower, and that clearly did not happen. I think a lot of folks had forecasted lower interest rates going into 2026. There was a lot of rhetoric out of the White House. We saw a lot of pressure from President Trump on Fed Chairman Jay Powell to lower interest rates. And, really, it hasn't happened. In fact, if anything, they've gone up, which is ironic because a lot of these things coming from the White House has forced rates to go higher, whether it be tariffs last year, whether it be the war against Iran this year. These are things that have caused inflationary pressures and have forced the Federal Reserve to put a pause on interest rates. Now, his outlook changes. I'm not surprised. My outlook changed along with him, and I said this several days ago. If you go back to an episode I did called the Q1 2026 Housing Report, that was back on April 1st. I talked about how we were actually starting to see a real recovery begin. You saw momentum building, activity in the housing market was picking up, and it looked like the market was finally starting to turn the corner. And I had actually said that. But even then, I also said that I thought the recovery was pretty fragile. And over the last month or so, that's pretty much what it's become due to the geopolitical issues that we've had along with rising oil prices. So Lawrence Yun, the chief economist at the NAR, is basically confirming this exact shift we've been talking about and seeing. He's also said recently, and these are some of the other things he said the other day, home sales have remained quite sluggish. So even though we had signs of improvement earlier this year, the data hasn't followed through. Now, there is another layer to this that I want to bring up. I talk about it quite often. It is inventory. There are more homes coming onto the market. Supply is improving. Listings are rising. Construction is still happening, especially in certain parts of the country. But the issue is demand is not catching up. And now we're taking another hit to demand with rising interest rates. So more supply without the surge in buyers. So when you do zoom out of this whole situation, this is your setup. Rates higher than expected, rates higher for longer, affordability still very, very tight, inventory rising, demand is not accelerating. And what do you get when you put all that together? You get a slowdown, you get a slower housing recovery. Now this lines up exactly what we've been talking about since Q1, and it's a fragile, already fragile recovery that's being tested again. Now, do I think there's some serious impact as far as, will this cause the housing market to crash in certain areas or, and all that? No, I still think we're overall stabilizing. Rates aren't shooting up from 3% to 6%, or they're not going to double like they did back in 2023 and 2024. But just because it's so fragile, that little bit of increase will slow things down. So that's essentially the way I look at it. Now, if you do get, the good news is this. Excuse me. The good news is this. We saw rates when they were in the low sixes. We saw a decent recovery start, again, nationally speaking. So if they were to make their way back down, which I'm still hopeful is possible at some point this year, then we could start to see the recovery pick back up again. So look at it as a recovery that's just getting delayed, perhaps, is my hope, at least. All right. Before I wrap this up, I want to give you my opinion on all of this, because this is something that you see over and over again. It's not just in housing, but in the stock market too. This part's really important, and it's really being shown right here in this situation. Economists like Lawrence Yun, they make these forecasts, and I see this in the stock market too. You see these analysts, they come out with their price targets of whether it be a certain stock or S&P 500 or whatever it may be. They tend to start out one way and then things change, right? Something in the macro environment changed that nobody expected or nobody thought would happen. And then what do? They revise the forecast. And you see this all the time. You see price targets get raised and then lowered in the stock market. You see housing forecasts go up, then they come back down. And it's not because these people don't know what they're doing. It's just because they're trying to predict something that's constantly changing, that's constantly evolving. And there's these, economic shocks that seem to happen almost at least once a year. And they can't predict that. The biggest thing they cannot predict are these geopolitical events, wars, oil shocks, inflation surprises. Those things can shift the entire macro outlook almost overnight. And when that happens, these forecasts, well, guess what? They get adjusted. So the way I look at this, I take all of these forecasts and I suggest you do the same thing with a grain of salt. I think they're useful. I think they give you direction, but they're not guarantees, because at any moment something can happen. Something out of our control, something out of their control, something entirely just unexpected. And that outlook, of course, will change. And when that happens, all the forecasts, you can just throw them out the window, including mine. That's just the reality of how these markets work. So don't follow the forecast, follow the data as it's happening. That's the key, and that's what I try to do. Try to look at the data, and I tell myself, okay, based on this data, what do I think is going to happen? But I understand that all of it can change, but the key is sequencing the change and figuring out how it's going to impact going forward based on whatever it is that's, in the latest case of oil rising, how that's going to, it's going to impact interest rates, right? It's going to impact the 10-year, it's going to impact inflation because, there's going to be a reaction in bond yields. So with that said, everything I'm seeing is, I think we're range bound in that 6 to 6.5% range for interest rates. I think that's how we'll see to 2026. I don't think it's going to cause any type of housing crash. I don't think it's going to cause a housing boom. I think it's just what I've been saying, which is for now, just a delayed recovery in this already fragile housing market that we're in. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at the Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time.